it's not just this deal, but it's you've advised Hudson's Bay on previous deals as well, including its purchase of Lord & Taylor. Why does going private make sense for Hudson's Bay right now?
First, let me start by a modest correction. So we are not advising the company on this transaction. We have advised the company on a number of transactions in the past, including the Car-Stott transaction, and we are currently advising them on the sale of Lord & Taylor to Latote.
Understood. Having said that, why does it make sense for Hudson's Bay to go private? If you could share your thoughts there.
There are a myriad of reasons. I think the big two are as you know, a very difficult retail environment, particularly in the department store segment, that I think is well documented. And the second issue is a very complicated story that's always been the case with Hudson Bay, because it really originated out of a desire to find undervalued real estate within retail businesses. And Richard and company were very successful in doing that, with the first transaction being Lord & Taylor and the second being Hudson Bay. And there was value created there, but it made for a very complicated story. And so that, in my personal view, maybe wasn't the best public market story to begin with. And now it's been even made tougher, given one, the continued decline in the department store marketplace, and two, the uncertainty around retail-oriented real estate.
Well, the cost over the next 24 to 36 months is one of the big reasons they said that they're going private in the first place. I think something that's staggering here, for example, is the fact that even when you're closing stores, you have to pay the leases on them, including as with Lord & Taylor. I mean, how much of a problem does that become as you're trying to turn around a business like this?
It's a huge problem, and it is not typical of anything you see in the public markets. This is now a turnaround, restructuring, a reboot of a business. This is not about consistent earnings quarter after quarter. This is about making transactions, making difficult transactions in order to preserve and create value. Yes, you mentioned some stranded costs in Lord & Taylor, which we did work on. There's about $75 million a year in stranded rental expense. Wow. In the Car-Stott transaction, they retained the Netherlands business. Another, I believe it's 75 thereabouts, for a 10-year period. These are very significant numbers, and not the kinds of things you see in a business like this in the public markets. I think it's the very reason why it's going private, because what needs to happen now is what I would call a very down and dirty, very nitty-gritty restructuring and workout, which I think the team there, Richard, Helena on the operating side, are well equipped to do. But is it for the faint of heart? No. And is it for the public markets? Absolutely not.
I feel like retailing isn't for the faint of hearts in general right now. And talk to us about, when you're getting down and dirty and doing these sorts of restructurings, what are the key headwinds that you're focusing on, apart from, say, the rental prices? Is it the new entrance to the market, the fact that people can now rent their clothing? I mean, what are the key priorities now for Hudson Bay?
Yeah, so it's all the above. And so their operating business, and their real estate, by the way, because their real estate is, in fact, retail-oriented real estate. If you could put condos up across the street from Rockefeller Center, you might have a different value proposition, but you can't. So it's a retail footprint. And the answer is all of the new technology that's disintermediating retail is having a massive effect on any and all operators. So whether it's the new digitally native brands, direct-to-consumer brands, whether it's rentals, whether it's Amazon, of course, it is pervasive, and it is makes life difficult.
Well, now they own Saks, big luxury brand. People are thinking we're getting into a recession. How do you proceed as a luxury brand owner, and how do those businesses fare as the economy starts to get worse?
The answer is they go down. In 2008, 2009, there's no doubt that when you took the big three at the time, Barney's, which by the way is bankrupt, Neiman's, which is close, and Saks, they all had downturns in that marketplace. Now, whether we believe that there will be a significant recession or not, I'd say the bigger issues are what we talked about a moment ago is what's happening in technology. The other piece which we don't talk about is who are really the suppliers to these big department stores. They're the mega brands. It's the LVMHs, it's the Kerings, the Guccis, those companies. And so they're becoming a bit ubiquitous in terms of what they sell as opposed to being differentiated. And on top of that, they're competing with those same brands in their direct-to-consumer offerings. Tough place to be when you have nothing other than your brand and your location.